Jessica Distel, Partner and Associate Director of Waverly Business Services. Today I'm going to walk through some opportunities taxpayers should look at before the tax return filing deadline. Believe it or not, there are still several moves you can make in 2026 that can lower your 2025 tax bill, even though the calendar year is over. First, make a prior year IRA contribution. One of the easiest moves is contributing to an IRA for the prior tax year. You can make contributions for the 2025 tax year up until the tax filing deadline, which is April 15th, 2026. Depending on your unique situation, a traditional IRA contribution may be deductible and reduce taxable income for 2025, or it may be non-deductible. But remember, when you contribute between January 1st and April 15th, make sure you tell the financial institution that the contribution is for 2025 and not for 2026. Second, fund a health savings account or an HSA. If you were covered by a qualifying high-deductible health plan in 2025, you may still be able to make a contribution for an HSA that counts for 2025. HSA contributions are above-the-line deductions, meaning they reduce your adjusted gross income even if you don't itemize. And just like IRAs, contributions can be made up until the tax filing deadline in 2026, but be sure the deposit is coded for the prior tax year. Third, claim credits and deductions you may have missed. Especially if you are preparing your own tax returns, review tax credits and deductions that often get overlooked. A few examples of credits are the Child Independent Care credits and education credits. Even small credits can dramatically reduce tax liability because they lower your tax bill dollar for dollar. And review your deductible expenses. Confirm if your itemized deductions exceed the standard deduction. Since the Tax Cuts and Jobs Act of 2017, we have seen a large reduction in taxpayers that itemize. However, the One Big Beautiful Bill has made changes to itemized deductions, and I anticipate there will be a significant increase in taxpayers that itemize starting with the 2025 tax year. And double check that you have included all of your charitable contributions, as these are often made throughout the year. Small errors here are one of the biggest reasons people overpay. Fourth, maximize self-employed retirement contributions. And if you're self-employed, this is a big one. Certain retirement plans like SEP IRAs and Solo 401ks allow contributions after year end, up until the filing deadline and even the extended deadline. These contributions can create large deductions for 2025 income, even though you can fund them in 2026. And fifth, know the deadline that matters. The most important date to remember is April 15th, 2026. And that is the deadline to file your 2025 tax returns, pay taxes that are owed, make IRA and HSA contributions for 2025, and request an extension. But remember, if you file an extension, it is an extension to file the form, not to pay the taxes that are due. If you anticipate that you will owe, you should still plan to make your tax payments by April 15th. And remember, not every strategy applies to every taxpayer. Income limits, coverage rules, and plan participations all matter. But the key takeaway is this. You still have planning opportunities in early 2026 that can reduce your 2025 taxes. Don't assume that the door has already closed.